Absolutely. Well, look, the first thing to say is that startups and small businesses are incredibly important in our economy. I say that as somebody who founded a startup, who grew a small business and sold that business. Small businesses create jobs, they create innovation, and we have to be a startup nation. And there's a lot in the budget for startups. Let me begin at that point. We are increasing access to venture capital. We are providing loss carryback reforms. We are providing reforms to the R&D tax credit. All of that will benefit startups, and that's important. Small business is also a really important part of our economy, and in the budget there is also a lot for small business. But let me go to the specific question. What we are doing here is not taking away the CGT discount and replacing it with nothing. We're taking away the CGT discount and replacing it with a different kind of discount. And that discount is a discount based on the rate of inflation. And that additional discount, that different discount, is better in many ways. It's better in the sense that it truly taxes the real returns. It's better in the sense that it levels the playing field between different types of assets. Under the old regime, there were some assets that were incredibly generously treated under the CGT regime, and some assets that were very badly treated under that regime, and people paid way too much tax. This is a fairer system, and this system matters.
Can I just ask about the fairness of it? Because there is an argument that actually you do want to incentivise people investing in productive bits of the economy. So buying a house may not then produce anything else. It might provide a house. Someone might be able to rent it if that's your investment. But you do want people investing their money in companies which then make things, which produce things, which drives more economic activity.
That is exactly right, Hamish. And that was the problem in the previous scheme. The previous scheme was way too generous, particularly to detached housing. And that's why we saw a huge proportion of Australians go into housing investment. And we had a much higher proportion of housing investment now than we did 20 years ago. Share investment has gone down. The proportion of Australians investing in shares has gone down over the last 20 years.
Investing independently, we would all have super,
all
right?
Through super,
Okay.
But independently investing through shares has gone down. And part of the reason for that is because the old capital gains tax regime was extremely generous to housing and much less generous to shares.
Can you understand, though, why for many young people who have not been able to purchase their first property, they're choosing to go into shares, EFTs, whatever, and suddenly they feel like the ladder's being pulled up in front of them, that they're trying to climb. That was their way to get some money on top of their income so that they could get the deposit for a property.
Yeah, well, Hamish, to use your analogy, the ladder has not been pulled away. It's a different ladder, and in many ways, it's a better ladder. They used to get the advantage of the CGT discount, which was a 50% reduction in their CGT gain. Now they get a different reduction in their CGT based on inflation. So let me give you a really concrete example. Someone investing in the ASX 200 over the last 10 years, they had a total return of about 9%. But big part of that was dividends, so their capital growth component might have been around 5%, a little bit more, a little bit less. So that person's getting about a 5% return. Well, under that regime, they're going to be pretty much equally well off with an inflation-based discount than they would be with the blunt 50% discount.
So will some people be better off? Will there be occasions where they're better off?
Absolutely, there will be. It won't be in every case, but let me give you a great example. We are sitting here in the middle of Parramatta, and around us, Hamish, are a bunch of apartment buildings. Now, for various reasons, the capital growth on those apartment buildings in Parramatta has been pretty weak.
Yep.
So you've got a lot of people who own apartments right around where you and I are standing right now. And if
they bought them for $550, they might sell them now for $450.
Well, let me be more generous than that. Let's say they bought them 5 years ago, and let's say they could sell them now for a small gain, like 10%, right? So those people are getting a 10% nominal gain, but inflation over that 5 years has been more than 10%. So their real gain is negative. And they're getting, under the old scheme, they're getting taxed on their nominal gain. They're getting taxed on that 10% with the discount. So they are paying money in tax. Under the new scheme, they have no real gain, and so they're paying no tax. So the people in the apartment buildings above us, many of whom over the last 5 years would have had a capital gain lower than the inflation rate, will be paying no tax under the new regime, but they would have been paying tax under the old regime. Now, not every single asset class or every investor is going to be in that situation, but that is something that has been missing from this debate. We're not taking away the capital gains tax discount and replacing it with nothing. We're replacing it with something else, and in many ways, that something else will be fairer.
It's 20 minutes past 9. You're listening to Andrew Charlton trying to make the argument for some of the changes, particularly on capital gains tax, included in the budget. There was another dimension to her question. That was Tal we heard from just at the end there. She was asking about what you're doing to consult more broadly than just with tech startups.
Well, I want to take her point to startups because this is a really important point because she raises something that really genuinely is an issue. And that is, if we take away that 50% discount and replace it with another type of discount based on inflation, there is a challenge with assets where you start with no capital because the inflation off that base, if that base is zero, can be very modest.
Yeah.
So the government recognised this before the budget. The Treasurer was consulting before the budget. There was in black and white in the budget a statement that there are special conditions associated with startups that need to be worked through. And the Treasurer is consulting on those to reach a landing point that supports startups. So the point that was made in that call is a really important point around startups.
Can I just need to jump in because a lot of people are responding to this, pointing out that you're not really acknowledging the 30% minimum on the CGT and that this is where the real problem is.
No. What people need to understand is that 30% minimum tax is a minimum on the real gain. So if they think of it as a minimum on the nominal gain, they're right. But if they think about that 30% as a minimum on the real gain, then they will understand why there will be people who are paying less tax under the new regime. Okay. Common misconception.
So the 30% minimum is only on the increase minus the inflation.
So think about that example of the apartment owner above us.
Yeah. Okay.
If they made no real gain because their capital gain was less than the rate of inflation, then they have no real capital gain tax to pay any tax on.
Yeah.
So if their real gain is zero, they're going to pay zero tax.
Scott in Westmead's trying to get through to you, talking about the fact that his wife is in tears about this. So I suspect that might furnish a little bit more information. Can we just try and knock off some of the other questions quickly if we could, because there are so many that are coming in. So Stuart in Bathurst, Sydney, the question about grandfathering a negative geared investment property. If it's transferred to a beneficiary on death, does the grandfathering stay with the property?
Well, look, let me just address one issue that's related to this. In this budget, there are no death taxes. All the issues around estates, there's no reason why anybody should have to pay more tax as a consequence of these changes. If it goes through a trust, it's a bit more complicated. If it changes ownership as a result of a transfer of the nature that Stuart described, then the negative gearing exemption doesn't survive that change.
Okay, so if it's handed on, that
in certain circumstances, yes.
Okay. It's probably not the news Stuart was wanting to hear. Belinda in Tempe, I'm not sure whether you know anything about that specific issue of funding for ovarian cancer, but clearly a reasonable distress there that we heard from Belinda. Very sadly lost her 34-year-old daughter, or 35 it may have been. Is there anything that you can add to the conversation there that's meaningful?
I mean, a very difficult situation. I think it is true to say that this government has invested in women's health more than any government in recent memory. We have made it an absolute priority of the government, an absolute priority of this budget across the board with investments in many different areas. So I think obviously there are people in very difficult situations, but this government has absolutely made investments in women's health, a centrepiece of our approach to healthcare, centrepiece of this budget.
But do you know why on ovarian cancer it may be a gap?
I'll have to look at the specifics there of that question from Belinda.
Okay.
But the general point is definitely strong investments in women's health care.
And look, to be fair, Belinda, we will go to the Health Minister and chase that particular question up for you. Peter in Marrickville asking the question about whether the new legislation would capture granny flats second dwellings.
So here, the question that I often get asked is, what happens if I knock down my house and rebuild, does that mean that I am able to get the benefit of these tax advantages? Well, what we've said on negative gearing is you need to be expanding the housing supply. So if you just replace your existing house, then no. But if you do a subdivision, then yes. If you are making 2 dwellings where there used to be 1, then yes, you can continue to negatively gear.
Even if it's a granny flat, because that's not subdividing.
Well, there are granny flats and granny flats, and it does depend on the nature of it as to whether or not you are expanding the housing supply. These definitions are clear; they are state government definitions, which relate to whether or not you are increasing the dwelling stock on that place or just adding to adding bedrooms and not increasing the number of units.
It is 25 minutes past 9. You're listening to Mornings on 702. Andrew Charlton is here answering some of the questions you have on the budget. A sort of broader point that was made by Helen in Sydney yesterday. She said, really appreciate you trying to make sense of the implications from the tax announcements. The complexity and uncertainty of it all reinforces my strong view that this proposal should have been put to an election. We could have analysed it, understood it, and had a say in whether we supported it in a meaningful way at the ballot box. Do you think you've made a mistake here in the way you're delivering these changes? The fact that you're here a week on from the budget having to answer these questions tells us there is a problem, at the very least, in the way you're explaining this to the public.
Look, tax change is always complicated, and the government made the decision that the challenges that we were trying to address were too urgent to kick down the road. We have had an acute problem with young people trying to get into the housing market. Young people turning up, trying to buy their first home and finding a whole bunch of investors pricing them out of the market. We have acute problems in productivity and economic growth. And the government made the decision that those challenges needed to be addressed with an ambitious reforming budget. Yeah. And the case I'm making to you today is that many of the measures in this budget will address many of those big challenges. Now, that
do
doesn't
you
mean
acknowledge the anger that is coming at the government over this, particularly the confusion around what the changes mean?
Look, tax is always complicated, and that is why the government is consulting. And we have acknowledged that there are areas where we need to do more consultation. In areas like trusts, we have said there will be a longer implementation period because there's a lot of complexity.
It's just a question of whether you acknowledge that you've made a mistake in the delivery of this.
No, I think that we were right to address these national issues and not kick them down the road.
But if so many people are confused, doesn't it tell you that there's a problem in the way you've gone about it?
Well, we are out there explaining these problems. I'm fronting up on your show. I am answering people's questions. We need to explain how they work, why we've introduced them, why we think they are better for our nation, why we think that the new approach to CGT is fairer, why we think that it levels the playing field, why we think that for some assets it will be a much better approach, why we think it'll help the housing market, why we think it'll encourage people into more productive assets. We are making the case that these changes are urgent and important. And I don't think I want to be kicking these problems down the road.
I want to play a bit of Mona, who called us yesterday from Ultimo, involved in a tech startup there, an AI startup. And I think the reason we should talk about this one is that it goes to some of the social media memes and the idea that the Prime Minister is taking a 47% stake in small businesses.
Now, in order for me to be able to attract really great talent, I have to be able to offer a package that big tech will always be able to offer better than me, and that's participation in the shareholding of my business. So what I've offered to the amazing people that work with me is a bit smaller pay package in numbers, but I'm able to add shares to my business so that they become shareholders that make up for that, that may not being able to pay what big tech businesses can pay. And that's how I've been able to attract my staff. Now, if 47%, and yes, I'm sorry, there's so much misinformation out there. These shares have now been reduced by 47%. So when we sell our business, God willing, and my staff get to participate in the success of that, 47% of what should be going to them is now taken.
But can I just check that claim about 47%? Because they'd already be taxed in some way, right? They'd be...
Yes, which is fine.
So it's not a 47... They haven't been reduced by 47% in value.
No, they have. So if we sell the business...
so that conversation went on for a while, but can you add any clarity to this conversation?
Yes, I can. I mean, first of all, I want to say, starters like that are so important in our economy. I acknowledge the risk that starters take. I acknowledge the impact they have on our economy for good in terms of employing people, in terms of creating value, in terms of doing innovation. However, the claims and memes that are floating around on the internet are just factually incorrect. And that is because we are not increasing the tax rate for those people in any way. They were already paying their top marginal tax rate on the capital gain in the old regime. So if they sold their business, they were paying their top marginal rate, their marginal rate on the capital gain. It's just that capital gain was being reduced by 50%, and then their marginal rate was applied to it. So what's going to happen now is actually quite similar, but they're still going to pay at the exact same rate. But instead of their capital gain being reduced by 50%, their capital gain is going to be reduced by something else. And that is by the rate of inflation that they have suffered cumulatively over the life of that investment. Now, whether that is more or less will depend on the circumstances of the individual and the business. But it is absolutely not true to say that we are somehow increasing tax to 40%, 47% on entrepreneurs or small businesses. They were already paying their marginal rate. It is not true to say that we are taking away the discount and not replacing it with anything. We are changing the way that discount is calculated from a blunt 50%, which overcompensated some asset classes, to an inflation-based discount, which is much fairer and a level playing field for all assets.
We do need to get to the news headlines, but people also getting in touch saying, look, how do we know this government won't break promises again? This now goes to a trust issue, right?
Well, I think the Prime Minister and the Treasurer have been very, very clear on this issue. This is a burning problem in our country. Young people being locked out of the housing market.
Yeah, but there's lots of burning problems,
extinguishing the Australian dream. Yeah. And when you have a big problem like that, which becomes a huge issue, governments have a responsibility to address them. What I've tried to explain in this interview is how we are really trying to tackle the biggest problems in our economy through these changes in a way that I genuinely believe will make a positive difference on those changes. Yes, there are details to work through. Yes, there is a consultation process to go through. Yes, we are learning as we speak to people and learn about their situation. But what we have is a genuine attempt, which I think is going to make a better economy and a fairer economy across people and asset classes.
Andrew Charlton, really appreciate you coming in and tackling all of this. We might have to get you back, I'm sorry, soon, because the phone lines are lighting up, but I suspect this debate's going to rumble on. So if we can line you up to do this again in the coming weeks, that'd be great. Andrew Charlton there, the member